If you woke up this morning and saw silver down 14%, you weren't watching a market crash. You were watching an execution, and it was allowed to happen while you were asleep. In a matter of minutes, silver fell from the low 80s into the low 70s. Accounts were wiped out. Confidence was destroyed, and a lot of people panic sold the bottom. But listen to me very carefully. This was not bad news. It was not profit-taking, it was not retail panic, and it was not a change in fundamentals. What you witnessed was a forced liquidation, a mechanical event, a financial assassination carried out in the darkest, thinnest market of the year. And the only way to understand why silver crashed 14% today is to stop looking at the headlines and start looking at the clock. Because this didn't happen at the open. It didn't happen in London. It happened at exactly 2 a.m. Eastern Time. So ask yourself, who is trading massive amounts of silver at 2 in the morning during a holiday week? And the answer is going to make you very uncomfortable. To understand the motive, you first have to understand the victim. And in late 2025, silver wasn't just another commodity. It was a coiled spring, an asset on the verge of a historic breakout that likely terrified some of the world's most powerful financial players. The run-up in price wasn't a fluke. It was the result of a superstorm of factors that had been brewing for years. First, and most critically, was the undeniable physical deficit. For the 5th year in a row, the world was consuming far more silver than it mined. This wasn't some minor accounting error. The deficit had ballooned to staggering levels. We were burning through global stockpiles at a rate that just wasn't sustainable. Industrial demand had turned into an insatiable monster. The green revolution is built on silver. Every solar panel, every EV, every 5G tower, and every AI data center needs a ton of it. By 2025, total global demand was projected to be around 1.2 billion ounces, with industrial use making up a massive piece of that pie, somewhere in the ballpark of 600 to 700 million ounces. This isn't investment demand that can come and go. This is structural. The silver being soldered into circuit boards is, for all practical purposes, gone forever. It's not sitting in a vault. It's being consumed. This relentless industrial hunger was creating a real squeeze in the physical market. All year the signs were flashing red. The COMEX, the main exchange for paper-silver futures, saw its registered inventories, the silver that's actually available for delivery, fluctuate, creating constant anxiety. Meanwhile, the number of paper claims, or futures contracts, stacked against each ounce of that physical metal was soaring, heavily outweighing the deliverable supply. Think about that. It's the classic setup for a short squeeze of epic proportions. It created a situation where if even a small fraction of contract holders decided to stand for delivery, the exchange could face a catastrophic failure. The price would have to explode to a level that would force sellers to find physical metal at any cost. Adding fuel to this fire was the behavior of some very big players. After decades of treating silver like gold's forgotten cousin, the smart money was finally waking up. Central banks, spooked by stubborn inflation, were looking to diversify. And after watching gold's historic run, they started eyeing silver not just as an industrial metal, but as undervalued monetary insurance. The gold-to-silver ratio was screaming that a major repricing was overdue. And then there was the elephant in the room. J.P. Morgan. The bank, historically known as the largest short seller in the silver market, had seemingly switched teams. While specific positions are opaque, the market chatter all year was that the single biggest source of downward pressure was stepping aside or even getting long. It signaled to the entire financial world that the game had changed. So as silver blasted through $50, $60, and then $70 an ounce, it wasn't a speculative mania. It was a reflection of brutal reality, of fixed and dwindling physical supply being crushed by exponential demand. The move toward $84 wasn't the peak of a bubble. It felt like the beginning of true price discovery. The market was trying to find a price high enough to finally slow demand, and that price was likely well north of $100. This was the threat. An uncontrolled, physically driven silver price would expose the fragility of the paper market, inflict catastrophic losses on the banks who were still massively short, and serve as a global vote of no confidence in the entire fiat currency system. Silver was no longer just an asset. It had become a liability to the status quo, a problem to be solved. They couldn't print more physical silver. So what other option was left? This wasn't just a chaotic sell-off. It looked and felt like a methodical, multi-stage operation. The perpetrators would have used a sequence of weapons, each one designed to trigger the next, creating a cascade of forced selling so violent it would shatter market confidence. Let's examine the evidence and the tools that could accomplish such a feat. Pause for a second. If the demand is real and the silver is physically disappearing, why is the price on your screen dropping? Are you watching a market reflect reality, or are you watching a screen reflect a lie? Let's look at the weapons they used to forge that lie. Weapon 1, the element of surprise, the liquidity void. The first rule of any heist is to pick your moment. The attack was launched in the pre-dawn hours of the U.S. trading day. This isn't just a quiet time, it's a calculated vulnerability. During this window, liquidity is at its absolute lowest. The book of buy and sell orders is incredibly thin. Think of it like this. In the 2-4 a.m. liquidity void, a large sell order can punch through multiple price levels in an instant. It doesn't need to be a huge order in absolute terms, it just needs to be huge relative to the non-existent bids on the other side. Executing this during the holiday week between Christmas and New Year's was another layer of genius. Many traders were on vacation, and risk managers were less attentive. It was the perfect time to strike when the market's defenses were at their weakest. The timing itself is a massive red flag. Weapon 2, the financial garrote, the margin hike. With the stage set, an attacker's primary weapon is often a sudden, punitive margin hike. While there was no specific CME advisory like, no, 25,393 for a 13.6% hike on this date, the tactic itself is a well-known financial garrote. Here's how it works. Imagine you're in a high-stakes poker game with a winning hand. Suddenly, the house declares that to stay in the game, you must instantly put up 10 times more money. You have the best hand, but if you don't have that cash in your pocket, you're forced to fold. That's a margin hike. When an exchange abruptly hikes margin requirements, every single trader betting on the price to go up gets a sudden, massive cash call. If a leveraged fund can't immediately deposit more money, their brokers' automated systems begin to forcibly liquidate their positions. They start selling, and when they do it in an illiquid market, the price collapses. It's the perfect way to trigger the first wave of forced, non-discretionary selling. It isn't a request, it's an order. Sell now, at any price. Weapon 3, the algorithmic accomplices, VAR shocks, and stop-loss cascades. The initial plunge from any forced liquidations is just the beginning. It's designed to trip a series of digital tripwires, unleashing an army of algorithmic sellers that turns a small fire into an inferno. The first tripwire is a VAR shock. VAR, or value at risk, is a model used by nearly every fund and bank to manage risk. When a sudden crash happens, these VAR models are instantly breached. Alarms go off, and the algorithm's programming is simple. If the limit is hit, you sell. These algos don't think or care about fundamentals, they just obey. At the same time, another set of tripwires gets hit, stop-loss orders. These are preset orders to automatically sell if the price falls to a certain level. When triggered in a cascade, they become a weapon of market destruction. Imagine a floor littered with landmines. The first explosion sets off the mines closest to it, and those explosions set off the next layer. That's a stop-loss cascade. As the price plunged, it hit dense clusters of these orders, with each one triggering a new burst of automated selling, pushing the price down even further and faster. This is how a controlled decline turns into a flash crash. Weapon 4. The accelerator, negative gamma feedback loops. If the stop-loss cascade was the avalanche, negative gamma was the force that made the snow unstable in the first place. This is a complex topic, but it's the secret sauce that can truly supercharge a crash. In simple terms, when the market is in a state of negative gamma, the dealers who sold options are forced to hedge in a way that accelerates the current trend. On the way up, they were forced to buy silver as it rose, but on the way down, the dynamic flips and becomes far more violent. As the price falls, their risk explodes, and to hedge themselves, they are forced to sell futures into the falling market. The more the price falls, the more they have to sell. The more they sell, the faster the price falls. This creates a terrifying negative feedback loop. This effect is what can turn a sharp drop into a vertical plunge. It's the accelerant that ensures a crash is so fast and violent that it creates maximum psychological and financial damage. These are the weapons: a liquidity void, the threat of margin hikes, automated VAR and stop-loss algos, and a negative gamma loop. Was this a series of unfortunate events, or was it a kill chain? In a crime of this size, you don't look for a lone gunman. You look for a syndicate with the means, motive, and opportunity. In the world of precious metals, the prime suspects are a familiar group, the large bullion banks who dominate the paper derivatives market. Their motive is simple: profit and survival. By holding massive short positions, these banks could make billions from a sudden crash. But more importantly, a continued, unchecked rise in silver's price was becoming an existential threat to their solvency. A move to $100 could have triggered defaults. They weren't just playing offense. They were playing defense to prevent their own implosion. They have the means. Only a handful of players have the scale to operate across multiple exchanges and design these algorithmic strategies. They know the market's plumbing because they helped build it. They know where the vulnerabilities are, and they certainly had the opportunity. The opaque nature of over-the-counter derivatives and thin holiday trading provided the perfect cover. We even have a precedent. Look no further than the 2020 spoofing case where J.P. Morgan paid a nearly $1 billion fine for manipulating the precious metals markets for years. Their traders placed huge, fake orders to trick others into trading at artificial prices. This proves, without a doubt, that the largest players have both the willingness and the ability to criminally manipulate this market. This brings us back to the curious case of J.P. Morgan in 2025. While others were threatened by the rally, what was JPM's position? Had they really flipped to a massive long position, positioning themselves to profit from a move up? While no definitive reports confirm a 750 million ounce long position or a specific $4.8 billion loss filing, their history makes their role the billion-dollar question. In this complex web, there are no simple heroes and villains. But the profile of the suspects is clear: a small club of sophisticated institutions with a history of manipulating this market, who had the means, motive, and opportunity to act. They didn't just want your money, they wanted your surrender. Think about this: if they can manipulate the price at 2 rough on M while you sleep, what stops them from doing it again tomorrow? Are you prepared for the next 72 hours, or are you waiting for the headlines to tell you it's safe? Spoilers: they never will. The overnight blitz was the assault. What followed was the cleanup, consolidating profits, and deploying a public narrative to conceal the crime. The immediate aftermath was financial carnage. The plunge triggered a mass liquidation. Leveraged longs held by hedge funds and individual traders were wiped out. Billions in paper wealth were transferred from the bulls to the shorts in hours. For any bullion banks who were short, it was a moment of staggering profitability and immense relief. The crash was so violent, It put severe stress on the system's plumbing, reportedly causing a liquidity crisis in the overnight clearing markets. Did it get so bad that a clandestine rescue was needed? While there's no public evidence of a secret $34 billion Fed liquidity injection, a crisis of this magnitude would have certainly raised alarms and potentially required behind-the-scenes support to prevent a cascade of failures. The takedown might have been so brutal it nearly took its architects down with it. With the system stabilized, the final phase began, controlling the narrative. As traders arrived at their desks, the financial media was already saturated with the cover story. You heard the same phrases on repeat. Investors are taking profits. This ignores that the crash happened in the most illiquid hour, driven by what looks like forced selling, not discretionary profit-taking. You heard, geopolitical tensions are easing, a convenient headline that ignored the core fundamental drivers. You heard it was a healthy correction, framing the crash as a natural market function rather than an act of sabotage. This is how a cover-up works. It doesn't rely on one big lie, but on a chorus of plausible half-truths that distract from the core evidence. The media, either willingly or out of ignorance, repeated the official story. They focused on the what. The price fell, but completely ignored the how. The real weapons were never part of the public conversation. The engineered takedown was successfully laundered into just another volatile day in the market. The massacre at 2:00 a.m. wasn't the end of silver. It was the desperate act of an elite class that has run out of physical metal. They can break the paper price, but they cannot print the silver required for the modern world. While they manipulate the digital ghost in the West at $75, China is still clearing physical vaults at nearly $90. The paper is burning, but the metal remains sovereign. The question isn't whether silver will recover. The question is, do you have the stomach to hold the line while they try to scare you out of your future? Decisiveness is the only currency that matters now. Choose wisely. I'll see you on the other side.